Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, unless you're living under a rock, we have all seen interest rates really jump up the last 3 to 5 to 6 months. Why? As we all know, or we likely know, the Federal Reserve has increased short-term interest rates a few times over the last some months, and primarily to curb or stop inflation. Obviously, inflation has been a problem. We see gas prices going through the roof. They've come down recently. We've seen mortgage rates double. We'll talk about that in a minute. But the Fed's sole purpose now is stopping the cost of goods from rising. And again, the way they do that is simply rising or increasing rates to curb or reduce demand, which theoretically will reduce prices. So we're going to talk a little bit about that today and how it may or may not affect you. So let's dive in. Well, last month, the Federal Reserve met and they raised interest rates about 0.75%, which was a third rate hike this year and the largest since '94. And really, again, as I noted earlier, the move was really to combat inflation because the rate of inflation was the most rapid, if you will, in the last 40 years. The Fed officials tentatively agreed, and at least the plan is for more aggressive increases next month in July, or actually, just to say this month in July and September, before getting back to normal quarter-point increases the rest of the year. Now, Fed Chair Powell said he does not expect moves of the size, meaning 50 and 75 basis point, to be common. Now, note that at least in my opinion, I would say watch what the Fed does, not necessarily what they say. You may recall not too long ago, the Fed used the term transitory to describe what they thought inflation would end up being, meaning they said, well, we think inflation is just here for a temporary, i.e. transitory period of time, which obviously they were wrong. And, in fact, I think Janet Yellen, the Treasury Secretary, acknowledged she made a bad call in inflation. At least their projections. So I would say watch what the Fed does, not necessarily what they say. But again, per the Fed, more rate hikes coming, and at least in the short term, it seems to be helping curb inflation because we've seen some prices come down, specifically gas prices, at least over the last few weeks. So now, where do some firms think the rates are going to go over the next say 3 to 6 months or even into next year? Goldman Sachs, one of the largest, most reputable investment banks on the planet, said, well, by the end of the year, short-term rates should be 2.5 to 2.75%. And then really by the end of next year, they're projecting that short-term rates will be 3 to 3.25%. Well, let's give you a historical perspective on where short-term rates have been since the 50s. Now, remember, the Federal Reserve does not control long-term rates. They control short-term rates. So at least that's one of the things they control. So here's what short-term rates look like. Most recently, if you look at the far right, and of course, if you remember back in the early 80s when rates were low to mid to high, double digits, well, the things were challenging back then. And obviously, rates have come down really over a 30-year period of time, which we've all really enjoyed or benefited from. Now, the next chart, this chart here, notice that there's a black line. That is really what we would call the trend line. Notice that every time the interest rate, the short-term rates hit that trend line, it ends up reversing down. Now, again, if you refer to the far right here, rates have come up most recently. Now, it's anyone's educated guess, but will it hit that trend line, let's call it that longer-term downsloping trend line, and reverse down? Where, for example, rates right now are, let's call it around 1.75% on the short-term rate. Maybe the Fed increases them as they said they were going to later this year, and then maybe the markets, just to speculate here, the equity markets continue to sell off, and the Fed says, wait a second, things have gotten too bad, and maybe they end up reversing course. There's some conversation about that out there. It's a waiting game, and it's let's see what happens and see how the markets respond. But But make no mistake, again, it's not news that the Fed has made a conscious effort to curb inflation, and at least in the short term, it appears to be working. How does it affect you and your money? Obviously, as we mentioned earlier, if you're going to apply for a mortgage, it's going to cost you more money. You can see here, really, I mean, it's like in the last 6 to 12 months, long-term, or at least let's call it 30-year mortgage rates, have really doubled from around 3%, around the summer to fall of last year to around 6% now. I mean, that is a significant increase, in borrowing costs. Now, of course, if you're, again, applying for a loan on a mortgage, if you're going to get a car loan, it's going to cost you more money. And one of the things that, again, the Fed is doing is to try to get asset prices back to, let's call it, normalized level. And of course, as an example, higher interest rates mean, generally speaking, lower property values, because of course there's an inverse relationship generally between interest rates, or mortgage costs, if you will, and property values. And you're starting again to see the property values come down in other parts of the country. And I know real estate is more geographically, if you will, specific. So but again, just something to keep in mind. So interest rate sensitive investments, of course, have been getting hit or have lost purchasing power, as we've seen, for some time now. There's almost nowhere to hide. That's what we consistently talk about. Now, where we are in the market cycle. Again, we're in a rising rate environment. Is it the right time to own bonds or be investing in bonds? Certainly, there's more risk than historically there has been. Is it the right time to invest in stocks? I mean, as we talked about in the last few videos, the bear market tends to have 3 down legs. It looks like we just went through the first down leg. We're getting a little recovery here, but the truth is that we're in unusual times where we have a slowing economy, rising interest rates, and a very soft financial market where we had a lot of asset bubbles that appear to be have bursted. Even looking at, as an example, the cryptocurrency space. So will rates continue to go higher? Goldman Sachs and many other firms are projecting yes. Based on what the Fed policy speak is, the answer is yes. So we again think, at least based on the data, interest rates will likely continue to head higher. All that to say is, if you would like a second opinion on your portfolio or financial situation, you can go on our website. This is what our website looks like. In the upper right-hand corner, you could just click on the Contact Us tab and certainly fill out your information there, and an advisor will reach out to you to give you that second opinion. Thanks again for watching. I hope you have a great day. Bye-bye.